and welcome to this edition of the Northwest Capital Management Market Summary for the first quarter of 2023. I am Scott Fisher, and I will be your host for this session. Now let's begin. As our first graph indicates, the equity markets have recovered considerable ground in the last two quarters. This is particularly true of the international markets, but also holds for the U.S. markets as well. While the fixed income markets were more subdued, the positive returns have been welcome. In this video, we'll be covering the following. First, we'll review the Fed rate hiking cycle and where we stood at the end of the first quarter. We will also hit the economic impacts of Fed policy, touching on the trajectory of inflation, employment, and wage growth. A key topic this quarter is the impact of the interest rates on the portfolios of banks, which burst into view and culminated in the failure of several institutions and important regulatory moves to address the issue. We'll round out our discussion with a review of the outlook for GDP, employment, and inflation from here. And as always, we'll provide a recap of the market returns for the last quarter. Now let's review what happened in 2022 to get us to this point. Pandemic supply issues, the war in Ukraine, and abundant stimulus combined to drive inflation higher than it had been in decades. As the graph indicates, the Fed, in an effort to slow the economy, and in turn the rate of inflation, raised interest rates and did so more quickly than in any previous cycle over the past 40 years. The economy has slowed somewhat, allowing the Fed to slow its pace, but remains stronger than expected. As we know, both stock and bond markets responded with dramatic declines early in 2022, before recovering during the last two quarters. Bonds were particularly affected because when interest rates rise, bond values fall. Though things have improved somewhat, much of the damage in the bond market remains. While market impacts of the rate cycle grabbed headlines, more subtle but no less important impact was taking place inside banks. The business of banking is making loans with the deposits placed in their care. They are required to invest a portion of their deposits, held as security against these loans, in safe investments. U.S. Treasury bonds are considered by many to be the most secure investments available because of the unlikelihood of their defaulting. Unfortunately, nothing shields U.S. Treasuries from falling in value due to interest rate increases. And this happened in the portfolios of essentially all banks, but more in some than others. Once this was seen by institutional investors, they rapidly withdrew their money, causing a number of banks to fail. All banks have been stressed by this, and regulators have responded, but the upshot has been a dramatic decline in the willingness to lend on the part of banks, as we can see in the graph. Not all banks are created equal, nor are market segments. The largest banks appear to be sufficiently well-funded, but the crisis has not impacted them. They reside in the large value segment in the graph. The large growth segment, dominated by industries such as technology, is essentially free of a banking component. A small cap segment is where most of the banks most affected by the crisis are located. Unfortunately, they account for the primary source of funding for small and mid-sized firms, which in turn account for as much as 50% of U.S. employment. This does not bode well for a big chunk of U.S. consumption. The crisis appears to have subsided for now, but the bank portfolio issues have not gone away, nor has their hesitance to lend. The economic indicators reflected in the graph suggest the economy is slowing. Inflation has been declining for months, and the trend continues to hold. While markets have been generally positive in Q1, slowing inflation is an indicator of slowing growth. Wage growth and the jobs-workers gap are both on the decline as well, which should reinforce the downward inflation trend. This adds up to an overall slowing in economic activity. Bottom line, if the Fed's war on inflation is close to being won, this difficult market period will offer the opportunity for a new cycle to begin. Now let's go through our markets at a glance. For U.S. equities, in the first quarter, results were generally positive. The S&P 500, which includes large cap stocks, was up 7.5% for the quarter, but lost minus 7.7% for the year. Large growth outdistanced large value for the quarter, 9.6% versus 5.2%, but the reverse was true for the full year, minus 15.3% versus minus 0.2%. 7 of the 11 S&P sectors were positive in the quarter. Tech was best at 20.9%, and financials worst at minus 9.6%. Small caps were up 2.6% for the quarter, but returned minus 8.8% for the year. In the international markets, the developed market international equities returned 8.5% for the quarter, dropping the 12-month loss to minus 1.4%. Emerging markets also returned 4% for the quarter, cutting the 12-month loss to minus 10.7%. In the fixed income space, the 10-year Treasury yield fell from 3.88% to 3.48% in the quarter, lifting bond returns in the process. The aggregate index gained a welcome 3% for the quarter, trimming the 12-month loss to minus 4.8%. High yield returned 3.7% for the quarter, cutting its 12-month loss to minus 3.6%. In the inflation story, as we can see in the graph, the Consumer Price Index, or CPI, came in at an increase of 0.1%, well below the prior 2 months. This put the CPI at 5% on an annual basis, a big improvement from the 8.9% in June. If shelter had been removed, the monthly value would have been negative. While this is a substantial improvement overall, services inflation remains high, which could mean the Fed will continue on its path. The employment picture, one noteworthy positive has been how well employment has held up throughout the Fed tightening cycle. Unfortunately, this also means that wage pressures may remain too high to allow the Fed to change pace. The news on this front is good for 3 reasons. First, as the chart indicates, job growth is slowing. Second, the ratio of open jobs per unemployed person, though above pre-pandemic levels of 1.3, has fallen to 1.7 from a rate near 2.0. A big improvement. And finally, despite the strong employment numbers, the annual wage growth rate has fallen from 5.2% last year to 4.2% now. All of these are indications of a return to balance. As for the GDP picture, after registering 2 quarterly declines during 2022, GDP growth has been positive in 2022's second half, registering a surprisingly strong 2.6% in Q4. As you can see in the graph, estimates for Q1 GDP growth rates started quite strong as well, at nearly 3.5%, before ebbing to 1.5% as the banking crisis came into view. Interestingly, the Fed has estimated that GDP growth will be flat in 2023, which suggests negative quarters ahead if the Q1 number comes in as strong as expected. Now let's review what we've covered. The dramatic Fed rate hiking cycle deployed to combat inflation continued, with some evidence it is working. Battered bond values have negatively impacted bank portfolios, causing some failures, regulatory responses, and continuing concerns. Inflation remains elevated but is slowing. Employment is becoming more balanced, and wage growth is moderating. As economic balance proceeds, GDP growth should slow, taking the pressure off the inflation rate. And here's what we expect for the rest of the year. The rapid rise in interest rates will have the effect of slowing economic activity. The banking crisis will likely compound the economic slowdown and potentially trigger a recession. The Fed will likely ease its pace of rate increases and stop altogether if a recession materializes. Economic balance should begin to return to the inflation picture, the job market, and the overall economic growth rate. That concludes our market summary for the first quarter of 2023. This is Scott Fisher. Thanks for listening.